All right, welcome in. If you're new, super happy to have you here. If you've been here a while, I'm going to make this useful for you as well. This is meant to be the updated tutorial that has all the information in here. I'm going to start with need to know, and then should know, and then might want to know. So progressively, the information is going to get more optional. I'm going to assume that you don't know anything, but I'm also going to make it in a way where if you know a lot, it's still going to make sense and not be a waste of your time. So let's get into it. We're here on tradingview.com. This is where our chart is. When you're going to see the indicator into an invite only, you should see MTP beta version 4. That is granted by Third Millennium. If you do not see it, contact him. We're business partners. I've developed the concept and the ideas, and Matthew's Third Millennium has hired the developer. So this is sort of our team structure. So please contact. I don't know why I'm laughing. Please, there's no reason for me to be laughing. Please contact him if you need help. So that's how you find the indicator. Once it's on, you can do it like this. We generally try to have the initial default settings, what we recommend. But if you go to the Discord, there's going to be a channel. In that channel, Market Timing Professionals, it's going to say current best settings, and it's going to go in here. Double check everything is the same, and then double check that your backtest looks similar as well. Okay? Now, once this is on, my recommendation is to only trade Bitcoin, gold, NASDAQ, and S&P 500. You could trade Dow Jones. That's it. We'll talk about why later, but you can if you want. You can when you put up Bitcoin, use the one that has use Bitcoin USD Coinbase, gold with TradingView and NASDAQ. And then when you're there, you can right click them. You can click on the thing up here and say add to watch list. To add it to your watch list. You only need these 3 or 4. This other stuff I have don't need. Okay, so you have that. Now, what you're going to do is you're going to go to the indicator up here on the 3 dots. You're going to click that. Once you've confirmed that the settings are the same, and you're going to say add alert, you're going to set the expiration to the maximum it can be. It can only set it for 2 months on the cheapest plan. If you want to pay more, you can set it otherwise for longer. Otherwise, you're going to need to make a note on your calendar to reset your alerts every 2 months. You can set the message to whatever, you can leave it the same. And then for notifications, you want to hit send email, and it's going to send you an email when something happens, whether that is taking a trade or exiting a trade. And you're going to set that for everything that you're trading. If it's crypto, it's Bitcoin, it could be gold, NASDAQ. Personally, I'm trading mostly Bitcoin and gold. So you do that, and then you go live your life. So that's need to know. Once you have the trade, the alert, then you can put on the trade that day. It's not super time sensitive. I'm not going to tell you what broker to use. If you need help with that, we can talk about that in the discussion. But that's all need to know. So let's move from need to know to want to know, in which case we're going to go through all of the indicator settings. But first, I'm going to tell you should know. There's a number of concepts behind what we're doing. The first one is that the money supply is inflationary in fiat currencies, and this has been true across history. So there's a temptation and a tendency for fiat money supply to expand over time. They print more money. Sometimes there's cyclical busts that cause contractions in the money supply, but over time it goes up. This means that saving in US dollars is not a safe way to save your money. So you want to save something in hard money that appreciates versus the dollar because it's harder to create. So Bitcoin is costly to create because of the energy expenditure around the security, and it has a monetary policy that has very low inflation compared to fiat currency. Gold is very expensive to dig up out of the ground, and also there's a lot less of it than US dollars. And by the same reasoning, NASDAQ and the S&P 500 are real baskets of companies that are harder to reproduce than just printing money. So those are our main assets that we trade. a little bit about backtesting. These are the assets that perform the best in backtesting. We want our backtesting we want to trade assets that have the most data for them. So gold goes back 100 years, Bitcoin is the oldest crypto, and NASDAQ goes back 40 years, S&P 500, Dow Jones go back further. That makes it more likely that they're going to continue in the future, and also makes it more likely that the strategy is going to work. And the fact that we are robust, that the same settings work on all assets is really important because it makes it more likely that it's not just noise. A lot of system testing can show you good results, but they have certain problems because they're too over optimized. So it's important that we don't optimize. We're not trying to get the best backtest for Bitcoin and gold, even though they're amazing. We're trying to get a backtest that works on as many assets as possible. Okay, so typically buy and hold is a good strategy, and you can do that. Psychologically, it can be hard because you're not beating buy and hold, and I want to be able to beat buy and hold, and you can see from the assets or from the backtest, it's possible to beat buy and hold. So how do we do that? Okay, well, one of the reasons is because of the credit cycle and how in society where leverage builds up and euphoria builds up, and then leverage is wiped out and despair kicks in, and then leverage is built up and euphoria is built up. It creates reflexive price action in assets where if you look at Bitcoin here, for instance, where it has huge moves up and down, and it's not just Bitcoin that does this, it's also the greater economy, gold, and even the Nasdaq. So I mean, you see it in gold too. There's massive, insane run-ups, and there's really hefty corrections. And one of the things that so our trading system, and I want to call it an investing system. It's more like an investing system than a trading system. Is it is good at sidestepping these busts that happen as contraction as leverage is wiped out and then participating. And so does that make sense? That's the fundamental that you should know. Then let's go into want to know, which is we're mostly going to be going under the hood. One last note is automation. I haven't done this. I don't think it's necessary because it's so easy to trade manually. But there are some free tools that aren't our tools. There's external tools that will let you automate crypto spot. I don't know about leverage, but crypto spot with our system. You can Google that, or we can talk about it below. And what you do is, I think you set the alerts. When you set an alert, you're gonna add a webhook URL, and that's gonna send it to the exchange. You have to be very careful about setting the position sizing, but it is possible to automate it. I haven't done it. I don't really have a desire to, but you're welcome to do it if you want. Now let's go into the part where we go under the hood and look at the various settings. Okay, so the first thing I want to say is one of the things that we did that is awesome is we didn't just create a rote black box system that's closed. You can see how everything works. You can try to steal the system and go create it from code. I hope that you don't do that and rather work with us. And I don't want to give you the idea, but the point is for you to trade it well, it's important that you understand why. So we're going to teach you the whys and hows. Now, the benefit of having so many different novel togs and knobs and toggles, we have a lot of things you can change, is it allows us to experiment and see what creates better backtests. And through that, I have concepts of ideas. Many of them have turned out after testing to not work. And some of the best settings and ideas have come from users like you who have gone in and played around with the backtesting to try to understand and have come up with better settings. So please do so, and also please share results, and also please help new people as they come in when they're confused. Okay, so let's go through. First, at the top, we have start trades. I haven't used this, but if you want to backtest from a certain date, you can do that. The first area is just to show different levels on the chart, which I usually turn off. But yeah, you can do that. Shows this gives you an idea of where a trigger is going to happen. So I'm going to leave that on for now. Or you can do, let's show touched and crossed levels too. I'm just going to put it on yellow. So this, you can kind of put levels on the chart just to see where certain triggers, entry and exit triggers happen. Okay, so here, max recovery period day. This needs to be a high number. There's not really a reason. It's just the way it's coded. Trades plot, show trade boxes. We want this on. Otherwise, you don't see the trades. Trigger icons. A lot of this I don't use. Condition icons. Okay. So there's 4 trade triggers for entries. There's trigger 1 dip buy, trigger 2 breakout buy, trigger 3 peak sell, and trigger 4 breakout sell. The first 2 are long, the second 2 are short. I do not recommend shorting. I do not recommend shorting on Bitcoin, gold, and NASDAQ in particular because you just don't want to fight the power of them moving up. We have found that the breakouts or the peak sell does work on weak assets like altcoins. However, it's up to you if you want to do that. I don't really recommend it because it's quite time intensive. Because now instead of looking at 3 assets, you're looking at hundreds. And it's a little bit more time sensitive. You need to log in at a specific time of the day. But just FYI, if you want to farm money manually in a bear market, you can use peak sell. But I would rather just use your capital on something else. You start a business or do something else. Maybe later on we're going to have bots that short for you. The problem is even if shorts work, they're really time intensive. And time intensive means more chance of errors. So don't even worry about them. So you want dip buy and you want breakout buy on, and you want peak sell and breakout sell off. Breakout sell I really don't like. It can work on certain assets, but it's super time sensitive. Like you have to, it's too much, it's too hard for a human to trade. So trigger on monthly low, there's 3 options. So the triggers that we're looking at calendar highs and lows. So here we have the high of March, here we have the high of April, here we have the low of April, here we have the low of July. These are the levels that we look at. Now, trend following systems often look at, if you want the history of trend following systems, 30-day rolling highs and lows, 50-day rolling highs and lows. I like calendar highs and lows. I've just found it to work well. And as of now, not a lot of other people are looking at or basing their system around it as far as entries. But entries isn't all what gives us edge here. So just so you know. Now, for our settings, when it says touched, closed below, then closed above, or touched and closed above, it means, okay, what happens when price hits the low? So if it long, no matter what happens, if it touches the low, we go long. Or we want price to close below it on the daily, then close above it. Also very important. If I didn't say this, I should have said that in the beginning. I wish I had. This is need to know. It needs to be in the daily time frame. It has to be daily time frame. I'll put that. I'm gonna make a note of that. Daily time frame. Okay, I'll say that in text. What we finding works best is touched and closed above. So this is one of the things that helps us stay out of breakdowns. If you look over here, when price hits an old monthly low and just never reclaims it, just breaks down, that's when the breakout's happening. So to save us from that, it seems that touched and closed above is the best setting. Now we move further. Recovery closes. How many days, how long should it take to recover that low? Does it need to happen within a day? 2 days? Well, I found that 30 days works pretty well. So to give it plenty of time, so it could be, for instance, this one. This one is more than 30 days, but this low, if price it comes up and reclaims it over here within 30 days, it goes long. It doesn't have to happen right away. I don't know where we'll find too many examples of it. A lot of these are little edge cases, corner cases. Minimum age of crossed low and max age of crossed low. So do we want to go long on some calendar low that's 5 years old and say that that's a level? No, we want to put a maximum age, and something like 90 works well. And also, if it's the 1st of February and we just took the January low and the 1st of February, that's not a level we're coming back to. I want to say that level needs to be at least 15 days old. This is how we kind of align with trend followers. We're saying, hey, we're looking at calendar lows and highs, but that level needs to be at least 15 days. If it just takes yesterday's low, and it's not like a dip buy scenario, right? Now here we have price is greater than the simple moving average of 200. The 200 moving average is the average price over the past 200 days, which is on the chart as this green line here. Having this filter on keeps us from buying dips during bear markets. This one is really important, I think. It does prevent us from ever buying the bottom. We never buy the bottom. However, it keeps us out of some really nasty situations that can happen, like looking over here, the NASDAQ, the 2000 dot-com bubble burst. If you trade long enough, we're going to see things like this happen. I don't want to trade in extreme downtrends, so I have this on and it seems to improve results. Here you can play around with. So this is, you can say you have a filter of an asset class. So one way is if you're trading altcoins, you might only want to trade an altcoin if the total crypto cap is over the moving average. Or if you're trading stocks, you might say, I only want to trade stocks if the if the NASDAQ is in an uptrend. So I found that that does work. I prefer to not trade smaller caps, which would be either altcoins or individual stocks, but you could. Now here we have our stop loss, and this is one of the things that makes the system really good, is running an extremely wide stop. That keeps us in the trade for a very long time. I mean, I'm recording this January 2025 or February. You look, the orange line on the chart is the stop loss. Just so you know, looking at the chart, the orange line is the stop loss. The gray line is either the average entry of a dip buy or the average entry of a breakout buy. They're shown separately. So look how long this has been in a trade. It's because it's just trailing the stop very wide. So when we look at a stop loss, we're using average true range, which is ATR. ATR is just a measure of volatility. It looks back at X days, and then you can set the stop loss as a multiplication of that. So we found anywhere from 10 to 100 works well in terms of how many days to look back. So it looks back in the last 10 days and says, okay, on average in the last 10 days, gold moved 1% per day. Therefore, our stop loss is going to be 5 times that, which is 5%. Or you can look back at 100 days. I like 10 because especially if you end up trading smaller caps, 10 looks at recent volatility. So if things get really volatile, you want to take that into consideration. And generally, wider stops work good. A 5 ATR stop, excuse me, I'm getting the coughs. A 5 ATR RTR stop is extremely wide. A lot of traders have very tight stops. These are very wide stops. Not having a stop at all exposes you to massive loss during bear markets. Or if you trade with leverage, which the system does well, it exposes you to unlimited loss. So it's really important to use a stop loss. 10 or 100 ATR, 10's good, times 5. For a long time, we used 3.4. Recently, it seems that 5 is better. Okay, so you can have all these checked. This is just, these mostly are just combining the trailing stops between the breakout buy and the dip buy. Now this check here, minimum stop loss distance, it's not named well. What this is, so the system pyramids, which is adding to new positions. So if we see here, we had how many buy signals? 1, 2, 3, 4, 5, 6, 7, 8. There's a little green dot down here, and you can also see them on the chart. And you can also go in here if you want for visibility and turn on the arrows. So in theory, this trade started in October 2023, and in February 2025, it's still going. It's holding many positions, and this is why you might want leverage, because if you're up massively and you have new margin that can provide new positions and all your capital is tied up, you would want to add to your positions to trade the system. So it trades leverage extremely well. Now, most of the time, pyramiding indefinitely is really good. It seems to blow up the back test for SPX. I don't know why, but let's set this to 100. It's not actually going to take 100 positions, but it's going to always be adding. Now, if we reset pyramiding to 1, it still advances the stops like normal. It should. It looks like it kind of is. What does that is this checkbox here, which is minimum stop loss distance. If I turn this off and we're not pyramiding, then it's actually don't know in that one. I might need to ask. I don't know everything. It's confusing. There's so much going on. Anyways, I think that's what that's supposed to do. So trailing stop doesn't really matter. Nor does risk reward ratio. We're not having a TP like, oh, if price gets up so much, we exit. We do have a conditional close, which we're going to come back to. But having a trailing stop, it doesn't really matter. Like trailing at 25 ATR or 125 days, it never gets touched. So you can have it on or off. That doesn't really matter. Now we're in a breakout buy. Currently, the best setting is coming from just touching it and not closing above, which is really surprising to me. And I don't really like, but that's what it says. So essentially, if you're trading the strong asset, if on any day it hits an old calendar high, it takes the long. One more thing. So let's talk about the conditional close. For the dip buy, it's off. But for a breakout buy, we're going to have a conditional close we're going to come back to. That's where you see up here where it's not stop loss, but it appears to be taking profit. It's not taking profit because it hits a TP. It's taking a profit because there's a failed breakout. And that seems to improve the testing. Not on everything. It doesn't improve the testing on SPX. If you want, you can try to kind of optimize for the asset you're trading. But I also like to not only generalize it, but do it in a way that makes sense for me. So, and we'll talk about that a little bit later. So, touched rather than waiting for a close above it actually seems to be better. That happening within 20 days, so giving it plenty of time to. Actually, this doesn't matter. If you have closed above, then 20 days is good. But since you don't need it to close above, this number doesn't matter. For breakouts, we're using a little bit longer periods of filters. So remember, we looked at 15 to 90 days for an old low, 20 to 200 for an old high. We're willing to buy a price hitting a 200-day high, right? Now, I have the 200 moving average filter off for breakout buys, and the reason why is because we have the conditional exit. Once we added the conditional exit, it allows us to be a little bit looser on our entries. If we didn't have that on, I really want to have this 200 moving average filter on, okay? Now for the breakout buy, for whatever reason, we've got 100 times 5 here. It could be 10, it could be 100. I haven't totally made my mind up on that. Some of the assets really like shorter periods versus longer periods in terms of look back, but regardless, we're using 5 times that ATR period. These checkboxes here are the same as for the dip buy trigger 1. They just make everything advance all the stops and everything together. Right, so let me explain the system to you a little bit. I've come so far and haven't exactly done it. So now you understand both of the triggers, and every time it takes a new entry, it advances all of the stop losses together to the new stop loss. So that's why you see this orange line constantly raising. What's causing it to raise? We're not trailing it at a particular distance. Every time we add a new position, presuming the new position is in profit, we are advancing our stop loss. So eventually, eventually everything's going to get stopped out in profit. And part of the idea is that the world produces trends of unknown magnitude. Those trends can go much further than expected, and because we don't know how far those trends can go, I'm going to turn off the lines now. You want to stay with them and not take profit prematurely. Makes sense? However, I'm going to turn off these arrows too. No, I'm going to leave them on. Again, risk reward doesn't really matter. However, one of the issues, especially for assets that have greater boom bust cycles like Bitcoin, that are so cyclical, is if you hold and wait for stop loss, you give out a lot back. So I'm personally interested in how do we get out of the top. And a way to do that is this little checkbox here on trigger 2, which says exit on turn 3 trigger 3 condition, which is the peak sell. So if price touches an old monthly high, an old calendar high between 15 and 90 days and falls below within 2 days, then we exit all the positions. And what that does is, let's put cross levels back on, touch levels. Okay, so what that does is for instance, we're in positions here, for instance. So it's taking breakout along here, a breakout along here, a breakout along here. This is the 2021 top in Bitcoin. On this day, price makes a new high. The next day it falls under. That is the condition of a peak sell that closes out all the positions. Okay, that also happened as I'm recording this recently, where it accumulated a bunch of positions and it closed out a lot of them right here, as you can see on this failed breakout. Now, if you want to be really conservative, you could have this trigger 3 exit on for dip buys too. It seems to make results worse, but it can maybe prevent you from losing money. So for instance, if you turn that on, excuse me, it would have exited everything here, and it shouldn't be in this long. That's a little bug that we need to fix, because if you think about it, if we're supposed to exit on a fail, it's not supposed to take a trade here. So we're constantly improving it, making adjustments, but that's the reasoning behind every little parameter. Now, if we go to properties, this is just for backtest, initial capital, base currency. Pyramiding I already spoke on. One of the common questions is how much should I risk? What's the order size? That's totally up to you. I cannot tell you how much. I don't know how much surplus income you have. I don't know if you have more capital coming. I don't know if you have money off inheritance or savings or what the deal is. I don't know if you're down to risk a lot or a little. What I can say is, excuse me, you can decide for yourself, and using the system you get to choose. So when you take a particular entry, say you took this breakout on gold, and you measure out the stop loss down here, you can measure the stop loss and say, I want to risk X dollars. I want to risk XYZ dollars. You could say, I want to risk XYZ, therefore I'm going to make my position Z. So you decide how much I can't tell you what the number is, but decide how much you're willing to risk and lose that's survivable for you. It might hurt, but it's not everything. It could be 1%, it could be 10%, it could be 50%. I'm not here to tell you how much that should be, but decide for yourself. Imagine the scenario of you losing that money and being okay with it. I recommend enough that hurts, because that gives you a chance to make something that matters. But that's up to you. It could be a little, it could be a lot. You might be more about trying to protect money than make money, or you might not have much and you're willing to risk to make something. But because there's a stop loss, you get to measure your risk and choose your unit contracts depending on that. Now, again, where to trade these assets, that's going to be a discussion you can ask later, but basically what I can tell you is if you're an American citizen, you could trade Bitcoin on a regular exchange, or you could get a Palau digital ID to trade crypto perpetual futures exchange like BitGet, MEXC, Bybit. I'll say it again, Palau digital ID, Palau. That is a costs about $250 and it will give you access to trade crypto futures, which gives you leverage. Leverage is nice to have because in these scenarios, if your first couple positions you use all your capital and you're still in profit, and actually everything's now at break even, when there's new signals, you would want leverage to be able to add on your position, and that's a way to do that. For if you're not a US citizen, you can just trade futures. And you could also trade spot, that's fine. For gold, if you're not a US citizen, is the easiest. You can trade CFDs. If you are a US citizen, your hands are tied a little bit. I'm going to turn these lines off. So if you're not a US, if you are a US citizen, you could trade Pax Gold, spot, or a gold ETF. That's an unleveraged way to do it with low fees. Um, or you could trade Pax Gold with leverage. The problem is that has high fees. You could trade gold futures is what I do. The problem is it's very expensive. A contract costs a couple $1,000s, and your minimum risk is going to be like $2,000 or $3,000 per trade. So same thing with NASDAQ. You can trade futures, but it's expensive, and S&P 500 is expensive and high risk. Or you can trade ETFs, which are unleveraged. I don't recommend leveraged ETFs. They erode over time. They're not meant to be held long term. Um, it helps to know that typically there's less than one trade a month. So you're generally going to know the maximum you could lose in a month, what that would be. There are periods where it takes a number of consecutive losses. Let's look here. I'm going to see. So this is why it's important not to risk everything. Although here actually it's taking some profits. Um, yeah, so you got to be aware. If we look at Bitcoin with the current settings, it's showing a 76% win rate, with gold a 50%, with NASDAQ a 58%, and with SPX a 47%. So generally, but a little over 50% win rate, it still means you're going to lose consecutive trades. So keep that in mind with expectations and risk. That's enough. I'm trying to include everything, but if you have any questions, please consult the group. And if you're a veteran, please help the new people. Okay? Appreciate y'all. Much love. Talk to y'all soon. Peace.